If you're not claiming every tax break that you can, you're leaving money on the table. The CRA offers literally hundreds of tax deductions and credits, so it's likely that most Canadians miss out on money that they're entitled to. Now, it's impossible to go through every single tax break in one video, but after years of working with clients, I know which ones Canadians miss most often. And today, I'll break down the most overlooked tax breaks that could put serious money back into your pocket. And stick around till the end because I'll show you how to file your taxes for free and use software that automatically flags these missed deductions, so you never overpay again. Alright, let's start with the Canada Workers Benefit, or the CWB. The CWB is supposed to help low-income Canadians, but up to an estimated 240,000 eligible people don't claim it annually, leaving $175 million on the table. Why? Well, the CRA's application process is somewhat complicated and many people don't even know that they qualify. Paper filing makes it even worse. Only half of paper filers claim the benefit compared to those using tax software. So if you're a low-income worker, this is free money you don't want to miss. Next is pension income splitting. If you're retired and your spouse is in a lower tax bracket, you can save thousands by using pension income splitting. This lets you transfer up to 50% of your pension income to your spouse, lowering the total household tax bill. The result is less money lost to taxes and more in your pocket. Now, despite the massive savings potential, many retirees don't take advantage of it. Whether because they don't know about it or assume that it's automatic, which it's not. But you just need to fill out form T1032 with your return each year to claim it. And here's a pro tip: if you're retiring soon, start planning early so you can adjust pension withdrawals strategically. And that's something we help out our clients a lot with. Next is moving expenses deduction. If you moved at least 40 kilometers closer to a new job or school, you could deduct moving expenses, including travel, storage, and even temporary accommodations. The catch? Most people forget to track their receipts, meaning they miss out on hundreds or thousands of dollars in deductions. The CRA definitely won't remind you, so if you made a work-related move in the past year, dig up those receipts. And here's a pro tip: you can only deduct moving costs against your income earned at the new location. So if you moved but didn't start work or school yet, you'll have to wait. Next is spousal RRSP contributions. Now here's a tax saving move that a lot of couples completely overlook. Instead of maxing out your own RRSP, contribute to a spousal RRSP instead. Why? Well, it helps spread out retirement income, reducing taxes down the road. If one spouse earns a lot more than the other, this is a golden opportunity to lower future tax bills. But many people don't even think about it. And as a bonus, you still get the immediate tax deduction, but later when the money is withdrawn, it's taxed under your spouse's lower rate. Smart, right? Before you go on to the next tax break, if you want to keep more of your money and pay less in taxes during retirement, I've put together a free guide with 5 proven strategies to maximize your savings. You can grab your free copy on my website, the link is in the description. Next is home buyer's amount. If you purchased your first home recently, you might be eligible for the home buyer's amount, a non-refundable tax credit. And as of 2022, eligible first-time homebuyers can claim up to $10,000, which translates to a tax reduction of up to $1,500. But despite its benefit, many first-time homebuyers are unaware of this credit and fail to claim it on their tax returns. Home office expense deduction. With the rise of remote work, this allows employees and self-employed individuals to claim expenses related to their home workspace, such as rent, utilities, and internet costs. However, many eligible taxpayers overlook this deduction either due to a lack of awareness or the perceived complexity of the claims process. In the 2023 tax season, Canadians claimed a total of $2.08 billion in home office expenses, marking a 41% increase from the previous year, but many are still missing out. Tuition and education credits. Students can claim this to offset the cost of post-secondary education, and also unused credits can be transferred to a spouse, parent, or grandparent. However, many students and families are either unaware of these credits or unsure of how to claim them, resulting in mixed tax relief opportunities. The credit applies to post-secondary tuition fees, but students must ensure their school is on the CRA's designated list to qualify. Childcare expense deduction. Parents can deduct things like costs for daycare, nannies, and certain educational programs up to a specified limit. However, many parents fail to claim these expenses due to inadequate record keeping or lack of awareness. The deduction must typically be claimed by the lower income spouse, and it applies only to the expenses incurred to allow the parent to work, study, or run a business. Charitable donations tax credit. Donating to charity can provide you with a tax credit of up to 33%. And if you don't claim it right away, you can carry forward unused donations for 5 years. So if you've been donating without claiming the tax credit, you might have hundreds or even thousands in tax savings waiting for you. Despite this, a lot of Canadians forget to claim their charitable donations on their taxes. And here's a pro tip: get your donation receipts together in one place now so you don't scramble at tax time. The student loan interest credit. Interest paid on government student loans is eligible for a non-refundable tax credit. However, many graduates forget to claim it, especially since financial institutions may no longer send automatic interest statements. If you don't claim it in previous years, you can carry it forward for up to 5 years. Now, this applies only to government student loans. Private loans and lines of credits don't qualify, so be sure to not make that mistake. Home Accessibility Tax Credit, or the HATC. If you're a senior or an individual with disabilities, you can claim the HATC for renovations that improve your home's accessibility. You can claim up to $20,000 in eligible expenses, providing a 15% tax credit, which translates to a maximum benefit of $3,000 per year. Despite its benefits, many eligible individuals are unaware of this credit and fail to claim it on their tax returns. Renter's tax credit. Now, I was surprised to read about this one, but if you're a renter in Canada, certain provinces offer tax credits to help offset housing costs. But it comes with very specific criteria. In Ontario, the Ontario Trillium Benefit, or the OTB, considers your rent, income, and age to determine eligibility. In Manitoba, renters can claim up to $525 per year through the Education Property Tax Credit. And Quebec offers the Solidarity Tax Credit, which includes a housing component for low-income earners. And if you work from home, you may be able to deduct part of your rent as a home office expense under certain conditions. Make sure to keep all receipts, as the CRA may request proof when reviewing your return. Eligible dependent amount. If you're single, divorced, or widowed and supporting a dependent, you might be able to receive the eligible dependent amount, which is a non-refundable tax credit. This credit can significantly reduce your taxable income, but many Canadians overlook it due to lack of awareness. To qualify, the dependent must be a parent, grandparent, child, grandchild, brother, or sister who is either under 18 or has a physical or mental impairment and must have lived with you in a home that you've maintained. The Tutoring Services Tax Credit. If your child has a learning disability, you may be able to claim tutoring expenses as a medical expense on your tax return. To qualify though, a medical practitioner must certify in writing that these services are required due to your child's condition. The tutoring must be provided by someone in the business of offering such services to individuals not related to the student. Many parents are unaware of this opportunity and fail to claim these expenses, missing out on these potential tax savings. Meals and entertainment deduction. Self-employed individuals can deduct 50% of eligible meals and entertainment expenses incurred for business purposes. While most business owners know this, many fail to meticulously track these expenses, resulting in missed deductions. Keeping detailed records of all business-related meals and entertainment can lead to significant tax savings, so it's very important to maintain proper documentation to support your claims in case of an audit. Carrying charges deduction. Investors can deduct fees paid for investment advice and interest on loans used to earn investment income. Yet many overlook these deductions, missing out on potential tax savings. Reviewing your financial statements and consulting with a tax professional can help identify and claim these eligible expenses, which can help reduce your taxable income. For example, for all of the investment management partners we have here at Blueprint, you will be able to write off all of your expenses related to their management fees. How to file taxes for free and never miss a tax break. Filing your taxes doesn't have to cost money, and the right tools can catch missed deductions automatically. Here's how to make sure you can claim everything you're entitled to. Use free tax software. For simpler tax returns, programs like Wealthsimple Tax and TurboTax Free can flag missing credits and deductions while guiding you through your returns. Check CRA My Account. You can review past tax returns and amend them for a certain amount of time if you missed a tax credit in previous years, meaning you could get money back retroactively. Then there's using autofill to avoid errors. Many tax programs pull your tax slips, such as T4s, RRSP contributions, and more, directly from the CRA, reducing mistakes and making sure you don't forget anything. And my take on the best way to stop forgetting tax breaks, because we all do it, is that most people don't miss tax deductions because they don't qualify or they're not aware. They kind of just forget to track them. And I've been guilty of that before in the past. Now, the trick isn't to memorize every tax rule, it's to set up simple systems that do the work for you. So what I like to do is use a receipt scanning app. Apps like Expensify or QuickBooks can automatically track receipts by scanning them with your phone. No more digging through old emails and paper piles. Make a tax receipts email folder. Most tax-related documents will arrive via email, so create a folder now so everything is easy to find when tax season rolls around. I like to make a separate folder for each year. Keep a quick tax deductions checklist. Every year before filing, run through a simple checklist. Did I claim my home office, medical expenses, investment fees? A quick 5-minute review can save you hundreds or even thousands, and I like to do this in a spreadsheet, which I copy for each year and add onto it so I don't miss anything. Each year, I learn something new from my accountant, and I usually add to this spreadsheet. Taxes get a lot more complicated when a corporation is involved and it's growing, so I'm always learning new rules. You're probably leaving money on the table without realizing it, and that's why at Blueprint Financial, we don't just help you find tax savings, we build full financial strategies to grow and protect your wealth. If you want expert tax and financial planning that actually works for you, check out our services at blueprintfinancial.ca. And please like and subscribe for more money-saving tips, and see you in the next one.